Hello everyone, welcome to our lecture on power of compounding. I think we will discuss this particular topic in detail. We are going to divide this particular topic in different parts. The first one would be we will understand about what is compound interest. In the second one, we will understand about what are the benefits of compounding. The third one, how the snowballing effect of compounding works, we are going to discuss. The fourth one would be cost of delaying investments. So negative power of compounding, what it could be. So I think we are going to discuss about that. And the eighth wonder of the world, we will discuss this in detail. So you must have heard one quote from Mr. Einstein. So he said, compound interest is the eighth wonder of the world. Who understands it, earns it, and who doesn't understand it, pays it. So I think this is a very deep meaning quote from Mr. Einstein. So we'll try and understand that particular quote in detail. So what is compound interest? So interest on interest is compound interest. So you are not taking out the interest payment or the returns payment you are not taking out. So example, you have invested 1000 rupees and you are getting 10% rate of interest. So we'll understand the compound interest also and simple interest also. So if you are getting simple interest on this particular investment of 1000 rupees, we will get back 100 rupees after 1 year. So that particular 100 rupees will not be reinvested, and on that reinvestment we will not get anything because we have taken out that particular money. So 1000 rupees earning 10% simple interest, every year we will keep on getting 100 rupees. So we are getting the interest payout. So vis-a-vis in compound interest, we do not get any payout, we reinvest that money. So 1000 rupees we have invested, at 10% it becomes 1100. Next year, 10% return will be on 1100 rupees instead of 1000 rupees. So 1100 rupees next year will give you 110 rupees. So 1000 rupees will become 1210 rupees in 2 years time. So this is what is compounding. This particular compounding goes on for years and years and years. So that's the most important part. So now we will look at the benefits of compounding. The first one is exponential growth. Now just imagine, so if you are earning a rate of return of around 12%, so means your money is growing or compounding at 12% per annum, then in that particular case, after 6 years, if you are invested 1000 rupees, after 6 years, that particular money will become 2000 rupees. After 12 years, that money will become 4000 rupees. I am going to give you number by number these explanations. So this is exponential. So over the longer horizon, the growth is quite exponential. So that's why. So compounding over the longer horizon works really well. So that's the biggest advantage. The benefit is long-term advantage. Compounding helps you when your investment horizons are long-term. So that's the important thing. Then the another benefit of compounding is reinvestments of earnings. So we are not taking out those earnings. So we are allowing those earnings also earn more money for us. So in terms of FDs, we know the rate of interest, but when it is about investing into equity markets, the compounding magic works really well. The rate of return will be on a higher side compared to fixed deposits if our investment horizon is little longer. So then in that case, that particular advantage works really well. So reinvestment of earnings also works really well when we are thinking about compounding. And the last benefit or advantage is inflation mitigation, because in the earlier video also we have discussed about what is investing and importance of investing. There we discussed about why we need to beat the inflation, because that is also one monster which keeps on reducing the value of our money. So to beat that inflation, to mitigate that inflation, we need to have better returns, and that too from the compounding. I think it works really well. So inflation mitigation also, that particular benefit also we get when we focus more on the compounding part. Now This is an important slide, and I hope that you will pay more and more attention on that. So we are taking one example over here. So suppose you invest around 5 lakhs rupees today and expect this amount to earn 10% interest over time. Then the value of this money after 5 years, 10 years, 25 years, 30 years, how it would grow, that I'm going to explain it to you. So you start with 5 lakhs rupees. After 5 years, that particular money at 10% rate of interest will become 8 lakh 5,000. After 5 years, that money will become 12 lakh 96,000. After 5 years, that money will become 20.88 lakhs. Then it becomes 33.63 lakhs. Then it becomes 54.17 lakhs. And then after 30 years, it becomes 87.24 lakhs. The kind of returns we are getting on that money. So first 5 years, we are getting 3.05 lakhs rupees as returns. Next 5 years, the compounding magic is giving us 4.91 lakhs rupees of returns. Then next 5 years are giving 7.91 lakhs. After that, 12.75 lakhs. Then 20.53 lakhs. And last, 33.07 lakhs. So you just imagine the power of compounding. Return on interest on interest, or return on return. That is very important. Now in this particular example, we have discussed about 10% rate of return per annum. That is compounding. Now let's look at the bigger picture, or the exponential growth, which we have discussed about. In this case, let's apply rate of return of 14.4%. Why? Because rule of 72 says 72 divided by the CAGR will be the number of years you will require to double your money. So if we are getting, instead of 10% per annum, if we are getting 14.4% per annum, then the 5 lakh after 5 years will become 10 lakhs. After 10 years, it will become 20 lakhs. After 15 years, it will become 40 lakhs. After 20 years, it will become 80 lakhs. After 25 years, it will become 1.6 crore. After 30 years, it will become 3.2 crore. So 320 lakhs rupees. So look at the power of compounding. We have taken one example at 10% per annum CAGR, compound annual growth rate. One example of 14% per annum CAGR. So this is giving us 3.2 crores. So just imagine, this is the power of compounding. So with 4.4% extra return on 10%, instead of 87 lakhs rupees, now we are getting 3.2 crore. And if this particular amount or this particular compounding happens at 18% per annum, then every 4 years the money will be double. So we are going to get at least 7 money doubling cycles. So I think this is the power of compounding, and that's where we need to focus a lot of our attention on. So this is a magic, and that's why he says compounding is a magic. So if we, the one who understands it earns it, the one who doesn't understand it pays it. It means what Mr. Einstein was saying, that if when we take even loans also, the rate of interest on the loan also is a kind of compounding if we are not prepaying the principal. So that's why the home loan mortgages and all those things, we have seen how people keep on paying it for 20 years, and in initial years it's just the interest payments, that's what they feel, that they're just paying the interest part, and the principal repayment starts after many years. So that's the point we need to understand. So this is the snowballing effect of compounding. That's how it works. Now let's focus on the cost of delay in investment. So this is also an important example which we are going to discuss over here. Consider that there are 4 people at different stages of their career looking to invest 50 lakhs for their retirement over their remaining working life till the age of 60. Say example, Mr. Arun is there, who is 25 years old. He will invest for the next 35 years, and the total amount would be 50 lakhs in 35 years. Mr. Bharat, at the age of 30, he will start for investing 30. For the next 30 years, he will invest total amount of 50 lakhs. Then Chetan, with 35 years as age, he will invest for 25 years to invest 50 lakhs rupees. And Mr. Dhruv, at the age of 40, he will start his investment. He will invest for 20 years, and how these numbers will actually play out, what kind of wealth it will create, and what is the cost of delaying investing, that we will understand. So if Arun starts at 25 and in next 35 years if he wants to invest 50 lakhs rupees, he needs to invest 11,904 rupees per month. So this particular money, if he invests at every month, and if he gets 12% per annum rate of return, the compounding happens at 12%. It means every 6 years the money is doubling. So in that case, the amount which he will invest for the next 35 years, the total amount of 50 lakhs will become 7.66 CR. So he has given 35 years for that money to compound. So that's the thing. Then Mr. Bharat, who started at 30 years, he will invest for 30 years. So total investment of 50, to make total investment of 50 lakhs, he needs to invest 13,818 rupees per month. So now this, Mr. Bharat's 50 lakhs rupees of investment, which will be there for 30 years over the period, he is not investing lump sum, over the period, will become 4.85 crore. So just imagine, from if the difference of 5 years, if the delay of investing, if it will be 5 years, the cost is so high. Look at the number, 7.66 CR for Arun and 4.85 crore for Bharat. So that is the difference. So more than 2.75 crore rupees of difference. So that's, and the amount invested is same, but the number of years, how that particular magic is working, and the cost of delay also you will be able to understand. Mr. Chetan, who started at 35-year-old, he had invested 50 lakhs at 16,667 rupees per month. His corpus after 25 years would be 3.13 crore. So look at the difference, the cost of delay. Then Mr. Dhruv, who started at 40, for the next 20 years he invested 20,833 rupees per month. So total investment of 50 lakhs. All these 4 people have invested 50 lakhs each. The horizon is lesser, and that's why the cost, the amount achieved will also be less. So Dhruv's 50 lakhs rupees will become 2.07 CR. So look at Mr. Arun, who started at 25, is having 7.66 CR at the age of 60, and Mr. Dhruv, who started at 40, is having 2.07 CR at the age of 60. So this is the cost of delaying investment, and that's why if you are becoming a wealth manager, so in that particular case, this is one slide which you should be in a position to tell your investors that please do not delay your investment. The cost of delaying investment is quite huge, and you need to mention these numbers to them. They will understand. So that's why it's always better to start early if you are in investing field. So now the 8th wonder, we will try and understand why it is called 8th wonder. This is a chart which is showing the rate of return is 15% per annum. So when we start investing for 40 years, let's see this 15% per annum for 40 years, these are all hypothetical numbers. The graph will be almost same. The percentage return will change a few things, but ultimately the gist will be same. So if the return is at 15% per annum, so initial first years you will think that nothing is moving, so why I am investing? So actually nothing great is happening. But if you just continue doing that, so in 10 years time, I think the money will be 3.5 times with 15% rate of return. Say suppose example, you have invested 1 lakh rupees. After 10 years it will become around 35 lakhs rupees. So now you will start noticing, okay, I think the amount is growing. Then after 20 years, the amount would be 14 times of that initial investment. So 14 times. So then you will start feeling the magic, the 8th wonder. Why it is called 8th wonder? So you will start feeling the magic. Then after 30 years, that number will become 57 times, and you will not believe it. You can't believe it. You will say that, boss, this is something different. You have invested 10 lakhs rupees and it has become 5.7 crore rupees. That's the power of compounding. Then after 40 years, that particular number will be 232 times. If you have invested 1 lakh rupees, that particular amount will become 2.32 crore. If you have invested 10 lakhs rupees, that amount will become 23.2 crore rupees, and that's what is compounding. Why? And that's why it is called eighth wonder of the world. So Mr. Einstein said that compounding is an interesting thing. You need to understand it to earn it. Otherwise, you will keep on paying that particular compound interest on your loans. So I hope that you have liked this particular video also. Stay tuned, friends. We will come up with next video. Thank you.